Welcome back, everyone, to session number 2 of the May special, Trading Elliott Waves and Wyckoff Methods. Today, we're going to continue discussion on about these two methodologies. And I was very excited to go again through kind of like a primer on Elliott Wave with Jeff, and just to look at his trades. So obviously, we have, somewhat different styles, I would say. And today I'm going to show quite a few of my trades in different time frames with different intentions and so on and so forth. So I'm going to be extremely curious to see, how Jeff is going to interpret them, and what kind of advice I could receive from Jeffrey on how he would trade that. So I'm looking forward to that. Hi Jeff, how are you doing today?
Doing very well, Roman.
All right. Well, with that, let's just jump into this, and we're gonna have 3 big sections today to the class. The first one is going to be on Bitcoin and just any thoughts on the crypto market. So we'll share just because of this drop. Then after that, very quickly, I'm gonna literally in 3 or 4 slides go through the Wyckoff method for those of you who are Elliotticians and not Wyckoffians. And I will quickly explain, the main tenets, and then after that we'll just jump into my trade analysis. All right. Well, with that, Jeffrey, I'm kind of curious, and maybe I should do this instead of putting on the slide. Let me put on the Bitcoin daily chart, and I'm really, really curious to hear your count, actually, and I'm sure that a lot of people here, our students, will be very interested to understand, what the count is since the COVID low. And then I know that you are more of the long-term investor in this market, but if you were a swing trader, how would you trade it? I mean, there are quite a few opportunities here.
Well, whenever I look at a market and you ask me what the wave count is in Bitcoin, I'm sure there's several different Elliotticians out there with several different opinions, but I'm more than happy to tell you what I think is going on, because
Yes,
sometimes
please.
what I think is not what other people might think. But basically, going back to the March low that you have in the bottom left-hand corner of your price chart, I like the idea that that is just a single straight up impulse wave into that August peak right there. So that would be wave 1. And then we pull.
I'm sorry, Jeff, you could actually draw as well if you'd like.
Oh, I can?
Yes.
Let me see. How would I do that?
So, that pen option?
Oh, yeah. Okay. I can do that.
It's it's under the drawing tools.
Okay, got it. Okay, so basically what I'm thinking here is from this point, you essentially have wave 1 up to here. And then from there, you got a wave 2 pullback. And the way I'm looking at the market is from there, all the way up to the high is my third wave price move. So I see that as waves 1, 2, and 3. And then the subsequent decline is actually a 4. And I like this interpretation, Roman, for several different reasons. Primarily because it adheres to several of, say, the Elliott wave guidelines. For example, there's one guideline that states that whenever a 5-wave move is complete, a retracement occurs and pushes prices back in the span of travel of the prior 4th wave. Well, the prior 4th wave is really this area right here on your price chart. Okay, and then the types of relationships we look for within a zigzag, a 5-3-5 pattern, which is essentially what this movement to the downside is. Typically, what we look for is equality between wave C and wave A, but in this instance, what you actually see is the point where wave C equals a 1.618 multiple of its corresponding wave A, which is still very totally acceptable. Now, also, too, what I like is if you look at your candlestick analysis, notice that the candles that we saw really primarily yesterday, you have a clear rejection of lower prices. very similar to the rejection of lower prices you saw back here in March of 2020. So I'm still kind of favoring the upside here moving forward in Bitcoin.
Mm-hmm. Yeah, absolutely. So let me just, with my extremely limited knowledge in Elliott wave, so you said this is 1, this is
Yep.
2, this is 3, this is 4. So
Yes.
obviously 5 is going to go there. You said this is A, B, and C. Am I correct?
Yes.
And
Yep.
then
That's
I
the way
think
I'm viewing it.
when I look at this structure right here, this downswing, to me it had kind of like a complex structure there, but probably what, like 1, 2, 3, 4, 5? Could we?
Something like that to really pull the internals out of that
Yeah,
out of C.
we would have to
You
go
have to
to
go
more.
to a smaller term time frame.
Okay, and then I'm just curious, like I'm feeling like I'm testing a new car, so I'm a little bit unsure.
Okay.
But okay, so if this is 2, the low here, right? So 1, 2, maybe like, ooh, here I'm a little bit lost. 4, 5? No, I'm sorry,
Well,
3.
no, what I've got highlighted in yellow.
Yeah,
That would be my wave 4 right there.
okay, 4. So this is
So
3.
you put 3 up.
Mhm.
And most likely that consolidation you're identifying between November and December. I will now actually, Roman, what I've done, because I think okay, the chart that I've got labeled, no, it's not log scale. What I've essentially done is where you scratched out wave 3,
Mhm.
I've actually got like a small wave 1 there.
Okay,
And then I drew a running flat correction, which ended in December.
okay,
And then the wave 3 pullback in 4, or the consolidation in 4, and then up in 5 of 3. And wave 5 of 3 in this instance has taken the shape of an ending diagonal.
okay. All right, got it. So, I guess, I mean, the main thing, and thank you for letting me play with this a little bit.
Oh, sure, go right ahead.
Yeah, it's very fascinating. I mean, like I've studied Elliott Wave, but that was, like 25 years ago, different life, and since then I have not, looked into this or touched this. So it's always fascinating to me, how you see this structure. I think the most valuable lesson, as I was thinking about your first session, is to understand where we have corrective waves and impulses, because that talks to me about the character of the move, what I could expect,
Mhm.
and that's a very important information. So from here, 5, how would you be expecting 5 to unfold?
Well, because wave 5 is going to be an impulse wave, I would be looking for wave 5 to develop in your classic 1, 2, 3, 4, 5 structure. And one thing I kind of picked up from your slides already,
Mhm.
it seems that the kind of like the move up I'll be looking for would be a small, I guess, it could correct me if I'm wrong, um, phase C and D
Yes.
of an accumulation period. Am I totally butchering Wyckoff here?
Yes, yes, not well. I mean, you're not, and yes, you are absolutely correct. So the shakeout that we've experienced, I believe, and I'm also bullish on Bitcoin at this point. Actually, I bought some today. Um, I, I, I believe this was a shakeout in potential phase C of this, more prolonged formation. But as I always would say, to all of you guys, listening to us, to be confirmed or to fail. So I want to see more evidence of this bullish call. So obviously first on the intraday and then on the daily. And the biggest bullish signal here, and I'm sure that Jeffrey would confirm this as well, is just coming back above the support level that was created by the low at the beginning of March or the end of February. That would show resiliency of the buying power that we've experienced on this volume spike. Despite that this was on the down day, there is a lot of hidden demand here. So we're seeing the strength of this demand. So 30 is very, very strong level. There were a lot of orders right there, and they were just being picked up, and then on the way up, momentum traders are getting in, and they're pushing right into the resistance right here. So this is a very crucial point. The more we penetrate the trading range back into the trading range, the better, the more strength we're showing. Okay.
Roman, if I could add, I know a lot of people were really shocked by yesterday's sell-off, but there's a few key points I would like to point out.
Absolutely.
A lot of the sell-off had to do with some of Elon Musk's negative comments about Bitcoin. China came in with increased regulations, made a comment there. You're seeing some increased regulations, I think, globally regarding Bitcoin. So there really was a lot of negative news that came out and actually hit this market. But also, too, the two key points about yesterday's price action is this is a great example of what I call Jeffrey's Law. Jeffrey's Law simply states that whatever adversely affects the most people tends to be what happens. Because if this had been an the normal orderly type of decline, that 42,000 mark was really perfect support for a textbook ABC decline. So what do? They run the puppy all the way down to 29,000. Again, I know a bunch of guys who were millionaires on Monday who are no longer millionaires today because of that move, and they freaked out. A lot of people got devastated. But welcome to the wonderful world of crypto trading.
Exactly. Yes.
And if this is the kind of volatility that you cannot stomach or understand, or more importantly, view it the way Roman and I are viewing it, as essentially an opportunity, then I highly recommend that cryptocurrency is not the arena that you should actually play in. So I actually like to see, believe it or not, I know this sounds really contrary thinking. I really like to see days like yesterday, because days like yesterday wake people up out of their hypnosis and to understand that making money in financial markets is not easy. And this is why professional traders, their number one focus, and Roman, correct me if I'm wrong, really, it's not necessarily making money.
It's preserving the
managing
capital.
risk.
Yeah, preserving the capital.
Go ahead. I'm sorry. Go ahead.
Oh, no. I thought you were asking me. So, yeah, preservation of the capital, through risk management and so on and so forth is of utmost importance. If you preserve the capital, you can play this game. If you can't,
exactly.
Yeah, you're going to be out. And then make money after that.
Yes, agreed. But you always have to manage risk. So I'm glad days like yesterday actually happened. It does offer, I think, this skilled or educated technician or trader opportunity, but it also wakes people up out of their stupor that there's no such thing as easy money when it comes to trading. There's always an inherent risk.
Yes. So here's that, Elon Musk. I called it a bad good trade by Elon. So he's buying, commenting, he's selling, he's commenting again. And yeah, it's just kind of like a bad good trade. Bad in the sense that, why come into the market when, you're not a long-term investor at this and you're just getting out. And good because he got out really well right before the shake. So bad good trade by Elon. Well, let's come back to our slides. It was an interesting spot right here. So, Jeff, let me post a little bit here. So I've been bearish since this bar right here. This just comes after a change of behavior, which at this point I was thinking could have reaccumulation characteristics. To me, this area right here has all of the reaccumulation characteristics: diminishing volume, signature, diminishing supply. After the change of behavior, where there is some profit taken, higher highs, higher lows, yes, shortening of the thrust, but I've shown you guys millions of examples when there is a shortening of the thrust in the reaccumulation and continuation. So that's not a big point for me there. But the biggest read probably comes once you have a change of behavior, and then you confirm it with the failure into the lower high. And then during that lower high, look at the volume signature. What's happening with the demand? Diminish and demand. There is no momentum. All of the bars, this bar is overcoming the resistance by a little bit. This one, which is the significant bar, an attempt to do the same, overcoming the resistance, cannot do that. And then there is no continuation in the expansion of the bars on the diminishing demand signature. Weakness, meaning that at the next time when we see synchronicity between increasing supply and increasing result to the downside, that's our signal to come into the position. So this was the call to the downside, and then we are confirming on this bar. And I thought that this test to this bar was so weak that we might have an attempt just to go up and then continue to the downside. But interestingly enough, on the next bar, we have such deterioration of that rally attempt. It comes right here. That right away you understand that not only you're going to continue to the downside, you're going to accelerate, you're going to have the largest volume signature and the largest bar, just because there's going to be some kind of general capitulation, as Jeff was talking about, those people that lost millions because they were shaken out. And that's exactly what has happened here. So here's my boast coming in, Jeff. I tweeted this right before the drop. That rally has not materialized, suggesting an aggressive continuation down. Something stupid, minus $10,000 day. And the target was really easy to define. I mean, like, this is just, the area of the value where they bought in before. So this was a relatively easy call to make, but, kind of in line, happened right at the correct time. So that's my boast for today. And Jeffrey, I'm done.
Excellent. Oh, excellent. Love it.
Yes.
Absolutely love it.
Okay. Well, let's go now and jump to the Wyckoff method. And I'm going to go quickly. For those of you who are not familiar with the methodology, you guys come to our website, check it out. And obviously, those of you who are Wyckoff and you got interested in Jeff's work, I would highly, highly recommend not just whatever publications Jeff has, but also his book. And I have it almost right in front of me. And I remember I got this book from Jeff at the conference, San Francisco conference, where we were going through the seminar, morning seminar on Elliott Wyckoff. So that was very valuable. So check it out. All right. So the main premise behind the Wyckoff method is going to be an idea, a belief that the trends or the price structures are being created by institutions that have a lot of money, a lot of correct information, a lot of good analysis, and because of their size, the size of their positions, they could move the market in a meaningful way. And not only move the market temporarily, but create those big waves, which we call big trends, where if there's going to be some kind of sustainability of the price growth. And then at the points of consolidations, those interests are going to either acquire, accumulate, absorb the shares, or any type of instrument. And then in the areas of the consolidation where, in their opinion, their model opinion, the price is overvalued, they're going to distribute this asset. So we're going to call them strong hands. We're also going to call them composite operator or the composite man. The composite operator, composite man is the heuristic that Wyckoff has given to the stock operators of the times. And he was very familiar with Jesse Livermore, interviewed him many times. I think that, they were actually friends. He interviewed and have known many other stock operators of the time. So he codified their behaviors in the course, which was published right before his death in 1934. It's still available. You could go and actually download it. I think either from SMI website or in the public domain, pretty available. So the main idea is that big money, and in our modern world, by herd mentality, as a herd, they buy and they sell, and that's what creates wave movement, and we call this the price cycle. The price cycle not necessarily starts, but we're going to start here with accumulation. And the accumulation area is the area where there is an active exchange of shares between strong hands and weak hands. Weak hands are capitulating and strong hands are acquiring. And into the end of the downtrend, there is an extreme point of fear where weak hands are capitulating. And this is where a lot of the climactic phenomena is happening. For instance, we might see the increased momentum, increased velocity to the downside. We're going to see the increase in the downward spread, gaps down, a climactic volume signature. All of this describes, those are the characteristics of the climactic run to the downside, of the capitulation by weak hands, driven by their fear of not possessing the shares anymore. At the same time, as the downtrend accelerates into the climactic run, this creates an extremely oversold condition that creates extreme value for big investors, like the composite man or the composite operator. And this is where we, for the first time, see the signs of intelligent accumulation. Sometimes, students are thinking that, institutions are accumulating somewhere at the beginning of the trend. This is true and not true. Some of the institutions are definitely accumulating when the trend emerges, but there is a lot of value-driven institution-driven models, institutional models that dictate buying even when weak hands are capitulating into the climactic action. The reason why the institutions really would like to accumulate at that point is because obviously this is extreme value at the time, plus there is a lot of liquidity from the capitulation by weak hands. They just dump in stocks, and the CO composite man, it just wants bigger size because their positions are just so huge. So this is a very prime time spot for them to start accumulating. Another thing that they have going for them is time. Their time horizon is really more of the business cycle. So when they buy, they expect to hold on to this particular stock for quite some time, for years and years. As they acquire the stock throughout the accumulation area, and Wyckoff method is acutely oriented to finding the timing of the trading range unfolding. We call those phases. So phase A, phase B, phase C, and phase D. Each phase has a character to it. Each phase has Wyckoff event to it. So for instance, I was talking about the selling climax. It's one of the events in phase A, the intention behind which is to stop the downtrend from going further down. This is where, again, big institutional money is coming in and absorption starts. This produces the largest change of behavior rally. We're going to call this an automatic rally, and then a test. We are testing the availability of the supply, and then we're going through a trading range into phase B, where the causality is being formed. Finally, we test again the availability of the supply at the support in phase C, and producing a meaningful change of behavior in the first rally and the first reaction of the uptrend, which we're going to call phase D. And then we go into the uptrend. And we also study, what kind of institutions, what kind of retail traders would act, in a different way during the trading range. After the emergence of the uptrend, and this is where weak hands are completely exhausted emotionally from trading and losing to the downside, from establishing either short or long positions within the trading range, and those positions don't go anywhere. So they're basically giving up at the point where the trend starts to emerge. At the same time, another breed of institutional investors are starting to adopt the trend, the new trend. Those are institutional trend followers. Their model are usually either trend following models, momentum models, and they're driven to performance matrix, to the absolute return and to the relative return. And they are starting to buy, and that's on the background of the value buying at the bottom of the trading range. So that creates a scarcity of the supply, because now supply goes to strong hands. And as the strong hands hold on to this supply, the price has nowhere to go but up, just because there is lesser supply. And as the trend starts to accelerate and starts to continue, the trend, or the tape, we would say, advertises the trend. And as the trend is being advertised, weak hands now are being excited, and they're getting into this position, into this trend. But they're getting into the trend, obviously, in the later part of the trend. We would talk about, more speculative nature of that part of the trend. And they are extremely excited because they are making profits. This is probably the only time when weak hands are making good profits. So think about 1999, 2000 top. Think about 2017, 18 top. Those type of climactic tops where there is a very, very broad participation by the retail people, by weak institutional hands as well. At the same time, into this excitement, the value investors that bought into fear are now starting to offload their positions, and they're distributing their positions. The reason why we sometimes do not necessarily see this really well is because the momentum of the trend is just immense at that point. There is just so much of buying power behind weak hands that when the value sells, or the value investors sell, it's only visible in the volume signature, in the increase in the volume spikes, and temporary stopping actions, and then shortening of the upthrust. And still, you would be thinking like this with Bitcoin, it's a part of the reaccumulation structure. And only later on, when this second part of the institutional investors, which is the institutional trend followers, start to offload their position, that's when we're starting to see some kind of deterioration into the sign of weakness, where we're starting to see lower highs and lower lows. Now, the question is, why would institutional trend followers give up their positions? Well, because again, remember that they're performance driven. So they need to see in 2 quarters deterioration in the absolute and relative performance. Once they see that, they are out. They cannot hold on for a long time to the stock that is, underperforming for a long time, and especially if it breaks, a price structure in any way from the uptrend, they will get out. So this deterioration starts with their selling, and then after that, we see kind of in the downtrend, late institutional capitulation and then general capitulation. So that Bitcoin, $10,000 day was a general capitulation. With that, the model is actually somewhat much more complex. So you could go through the cycle in a different way and understand that, in the uptrend, you're going to have some pauses. Those are reaccumulation ranges. In the downtrend, you're going to have some pauses. Those are redistributional trading ranges. You're also going to have different places where different hands, either weak hands or strong hands, value or trend following hands, are going to behave in a different way. And this is also what we acutely kind of like deeply study in WTC course that I teach. It's very important for us to understand, who's doing what at the specific point. for us to interpret the price action and the volume in the correct way. And then to make some kind of deductions as to what scenarios we might potentially see unfolding out of a certain consolidation. So as I said, usually we're going to see weak hands capitulating, value hands buying at the bottom of the trading range, trend followers starting to buy, then weak hands start buying into the end of the swing, and this is where the value investors are taking some profits. That profit taking stops the upswing from going up, and we go through the period of absorption through consolidation, where that supply from the profit taken by value investors, that it needs to be absorbed. So duration of the pause increases, and that's how reaccumulation trading ranges actually start unfolding, and so on and so forth, and reverse in the distribution. Again, if you are interested, come to our classes, and this would be a much better that would be a much better place for us to study this. I want to go with you through the accumulation and the distribution schematics. These are schematics that I've created for stock charts. They've been published by Stock Charts, became a little bit controversial in some of the labeling that I did here. By the way, that was done together by me with Hank Pruden, my mentor and my teacher. He passed away in 2017. His last session was at the Best of Wyckoff conference, online Best of Wyckoff conference in August of 2017. This was his a week before he passed away, and kind of tells you that he was teaching until the end of it. And he actually, after speaking to his wife, she said that that's exactly how he always wanted to go. So every time, I look at the schematics, I kind of remember Hank. So what do we have here? When we go through the trading range, remember I told you that we want to identify the sequence of phases. The sequence of phases basically show to us some price structural and volume characteristics that are saying to us that specific intention behind the phase has been satisfied. For instance, if phase A is all about stopping action of the downtrend, we want to see the first intelligent attempt to buy at the preliminary support. That attempt will always fail just because momentum is too high, and climactic run is going to develop into the low of the selling climax. Selling climax have specific characteristics. We want to see expanding climactic volume signature, stop in action, where maybe from the increase of the spread, we go into a smaller downward spread, and we see some kind of resistance of the price to go down on the increased volume signature. That would tell us that demand is present here, and that institutional types are buying right now, and that's what stops the trend. Then as the trend starts to stop, they're still buying. That's the rally that start producing short covering as well. So short covering is helping out. And then the momentum traders, short-term traders, start jumping on this change of behavior. And there we go. We have at the end the largest rally in the downtrend. This largest rally we're going to call a change of behavior. And that is suggestive of the change of the environment. From the downtrend, now we're going to go into a trading range. And with the trading range, we have only three objectives. We want to define the bias, up or down. We want to define the timing of when the price is going to get out of that trading range. And for more advanced Wyckoffians and traders, we want to define the character with which the price is going to go down or up. So as we go through phase A, we have our change of behavior. And then we are confirming the stop in action with the secondary test. It's a local test to the climactic action. Usually we want to see diminishing supply characteristics. It doesn't necessarily have to be a high low. It could be at the same level as the selling climax or even a slightly lower low. The main thing here is just to be in the vicinity of the support and then recover. And as we recover, imagine what is going on here sentiment-wise. So some of the people are still short, some of the weak hands are deciding to short. So therefore, volatility still persists in the first 1/3 of the trading range, still very high. For accumulation, we usually would like volatility to diminish, especially going into phase C, the final test of the supply at the support level. And as that sentiment still up and down, as we have two forces working behind this trading range. First one is just the sellers, and the second one is the buyers, and it's almost like weak hands against institutional strong hands. So that's what creates the swings in the trading range. And then as we go through phase B, volatility starts to diminish going into the second portion of phase B. And the final test of phase C might have multiple variations, actually only two. One is the higher low, we will call it the last point of support, and a lower low, which could be labeled as a spring or a shakeout. And depending on the character of the penetration below the support, we're going to call this one or another, spring or shakeout. Spring or a shakeout or a last point of support, no matter whether this is a lower low or a higher low, will create the lowest point of the uptrend. In some instances, you might say, well, what about this? This is the lowest point. So I'm considering the lowest point, the low in phase C. This is where the trend for me starts. The trend emerges with the change of character as well. First, change of behavior comes on the sign of strength rally. This is the rally where a very interesting manifestation of the absorption of the supply throughout the trading range unfolds. By the time that this rally unfolds, the supply is really exhausted. They were buying at the selling climax, secondary test in phase B. They had a second smaller capitulation by weak hands in phase C when the price briefly committed to the downside and then recovered really quickly. So the absorption of the supply, those levels of the absorptions were pretty high in this trading range. So at the point of this rally, supply at such a low point that the rally unfolds in a much more favorable bullish way in terms of the character. The upspread is increasing. We're seeing demand is coming in. We're seeing urgent demand. And the price goes up with the ease of movement. Not only that, the price actually starts overcoming the highs that were created in phases A and B, where the sentiment was still kind of like 50-50. At the high, it's more bullish sentiment. At the lows, it's more bearish sentiment. And then another change of behavior happens after the sign of strength. The next reaction is much more bullish than any other reactions in the trading range. And that's why we're saying that this type of events, like a sign of strength in the backup action, are true changes of behaviors from one environment, which is the trading range, to another one, which is an uptrend. And from here, as we've observed the supply first at the lower support level, and then later on, whatever supply was available at the resistance, we observed that too in the backing up type of action, we are free to go up. And this is where the uptrend starts. Now, my preference to teach you guys that we want to come in at the high probability point of entry, which for us is the backing up action and the break of that. Why? Well, because the supply that was at the support level was observed, and now supply that was at the resistance level was observed as well. If it wasn't properly observed, then we're going to have a failure, and we do not want to participate in the breakout. It's never going to come. So I would say that this is a very kind of like entry for the beginners, but there is such a beauty of the simplicity in this. And there is this high probability event that, could trigger so much profitable trades. The more students study Wyckoff method after that advice, the more they come to me and they say, well, Rahman, I want to come in somewhere here. Like I feel now more comfortable. How do I do that? This is definitely much more challenging. And there is, quite a few variations on tactics based on, price structures, whether this is accumulation or reaccumulation or a distribution. How would you, you know, differentiate your trades from the trades in the accumulation area and so on and so forth. So it becomes a little bit more complicated, but definitely with time, and usually it takes, years to practice and practice identifying this type of patterns and identifying the relationship between price and volume. That's what's important, obviously, relationship between swings, whether you upswing and downswing to a downswing, and so on and so forth. So we are constantly in the comparative analysis mode. We are not, as I say, predictors of what's going to happen. We are great followers of what we observe. So to us, the skill of observation is of utmost importance. The skill of deduction is extremely important because we need to understand how we could develop different type of scenarios and then observe what really is going on and act on that observation. So that's kind of like our goal as Wyckoffians and as traders, analysts, Elliottians, and so on and so forth. All right, let's jump into the distribution, and then after that, let's go to trades. I'm itching to kind of like dissect them with Jeff. Okay, so what happens during the distribution? As we were looking at the price cycle, I was telling you that the weekends are very excited at this point. They are making a lot of profits on the way up. This is the easiest part of the trend. Supply is in strong hands, so the price moves really easily. There are quite a few, months that this could go on. So therefore, throughout this months and months, people attract Jara and they advertise what's going on in their portfolios and their accounts to other people, and that attracts masses. The same with institutions, only in a slightly different way. Institutions have to look at the tape. They always look either at the fundamental data, macro data, or technical data, and they see the changes. So if the uptrend is unfolding, they could see this in the absolute and relative performance of certain assets, and that's what attracts them into those assets. So they also could become and act as weak hands, some of them. And usually the climactic run ends again with the initial signs of value selling, where they are selling into the preliminary supply and buying climax. I need to correct myself because this is an easy explanation. They are selling into the preliminary supply and into the buying climax. This is actually not true. It's because they are selling that the preliminary supply and the buying climax actually exist. It's because of their selling which creates the counter force to buying by weak hands in the last speculative portions of the uptrend. That's what creates the stop in action. And as they start selling more and more, finally, there is some kind of synchronicity between increase of the selling or increase of the supply and the downward result. And that's what creates a change of behavior. And we know by that change of behavior that we are changing the environment from the uptrend to a trading range. Usually this reaction is going to be the largest out of all of the reactions in the uptrend, or at least in the last speculative run. And then from here, we're just saying it's going to be a trading range. And again, with the trading range, what do we look for? Bias, timing, and character. Those are the three most important things for us as we analyze the trading range. Well, distributions, they're kind of like a mirror image of the accumulation. So everything is logically placed the same in terms of the behavioral analysis. The value investors are starting to sell into the highs. That's what produces first the stop in action, change of the environment, and then unfolding trading range with a lot of volatility at the beginning of the range. As buyers have bought and sellers have sold, volatility starts to diminish into the second part of the phase B. And that could be very easily confused and often is confused with the elements of the reaccumulation, which brings us to some kind of rally, which is the second point of excitement by weak hands. The first one being the buying climax itself. And we're either going to create an upthrust of the distribution, which is a higher high, the highest point in the trading range, distributional range, or a lower high, which we would label a last point of supply. Well, we need to conclude this environment. So we need to have another change of behavior, which would be a sign of weakness decline into the support, where we're going to see some kind of commitment below that support, which is being followed by a very weak rally, which we're going to call a last point of supply rally. The confirmation of this change of behavior is going to be a break below the low of the major sign of weakness. And again, this will be the high probability point of entry if you're shorting the market. And again, and I think rightfully so. I mean, the more knowledge you have, the more skill you develop, whether by coffee and Elliottian's knowledge, the more you want to be, maybe a little bit more precise, be closer to the beginning of the trend. It's definitely possible, not necessary, but possible. A very common question on trading here for me at this spot is, well, I don't want to miss the whole trend. And you're advising, like this kind of like high probability trades. My risk is increasing because my stop loss is somewhere here above the upthrust of the distribution, and I don't have enough size. This is absolutely not true. You could create a sizable position even in this mini structure. You just have to be a little bit more precise with your, intraday entries, and then have some kind of conditions that would transition your intraday trade into a swing trade. And we'll talk about this, in some of the trades. All right, I think that's it in terms of the methodology. So guys, especially those of you who are new to Wyckoff, do you have any questions? I didn't want, this segment to be very big because I want to go through a lot of trades. So let me know if you have any questions, comments, remarks. Jeff, anything from you?
Oh, I'm sorry, Roman. Just an observation. When I was noticing on your last slide, both with the accumulation and the distribution schematics, just kind of interesting here from an Elliott wave perspective.
Yes.
What I see kind of is, like, for example, a good way to again, a suggestion, one way to kind of get the feel of when you begin to roll over and you have that distribution, like, for example, these pullbacks right here, those are going to be, each one of those, every one that you've drawn, all of those are going to be a small three-wave counter trend move. Here's actually even a larger three-wave counter trend move. And then what you have as you move forward is, now instead of having three-wave declines, you have very small three-wave rallies. So whenever you start to see the rallies begin to develop in three waves, ding, ding, something's going on. And you can do the same thing, apply the same logic during the accumulation phase. As because when you're doing the markdown period, your advances, those small counter trend moves are going to develop in three waves, and then you base and either do your double bottom or your inverted head and shoulder, however you want to call it. And then as prices begin to move up out of the trading range, then your declines become three-wave declines. So just kind of an observation, but again, the similarity as far as the ebb and flow of the market, again, amazingly, strikingly similar to the wave principle.
Yeah, absolutely. And it should be, right? I
Yes.
mean, wouldn't we have two methodologies that are valid methodologies on the price action to be confirming each other? Because the truth, there is only one truth. There are no two truths or three truths or multiple truths. There is only one. So we're just looking at the truth through different lenses, really, but we're describing the same thing.
Yes, agreed.
Okay, well, let's jump into this, Jeff. I've been actually, let me just say this, I've been salivating at, these portions of our discussions. So I want to actively ask you questions here on each of the slide. I want to ask you questions probably in the regards of, well, what do you see here? That's number one. And regardless of how you would personally whether trade it or not, let's put you a little bit in the kind of like against the wall here, and we're gonna say like, if you were have to trade this would be the only instrument on earth that you could trade, and you have to apply your Elliott wave analysis and trading, skill as to how you would trade it or where you would trade it. I would want to know where you would trade it in the structure, and what and why you would trade it there. So here's our first trade. This is Twitter. So this is actually also a little bit unfolding trade. I have two trades here. I co-manage a hedge fund. So we have some long-term trades in this hedge fund, and then obviously personal accounts, and I trade stock options. I trade cryptos right now, and I trade sometimes E-mini futures. And it just depends on, I definitely more consistent with cryptos, stock options, and long-term investments. Futures, I trade, either when I have funds in the account or maybe like it strikes me and I see some patterns. In this particular slide, in this particular trade, we're seeing a long-term trade. This is point of entry number one. There were some add-ons along the way, and this trade is still on. So the long-term trade is still on. And then a short-term trade is a swing trade. This is options trade. So the intention behind the swing trade is just to take a small swing in the construct of a much larger structure. And the reason why we're entering here is obviously there is a trading range behind this. We kind of don't see it here, but recovery out of the climactic run here, we're seeing multiple testing points where the stride of the trend is being created. So another change of behavior or a sign of strength with the demand increasing. So that suggests buying power. Flat reaction. So we want to go into this position thinking that we're going to develop the rally right away. A gap with limited result. We go right into the oversold condition of this uptrend. So we're not giving up position here. Actually, we're adding after the test. And then another sign of strength, ability of the price to overcome, stay, another oversold condition, but notice this, less supply, test, less supply, so add here, and not only that, we're seeing how on the diminished supply, now we're thinking about options positions here. On diminished supply, we're anticipating that the rally is going to be much better than, let's say, this rally. So this is a much better rally for options than, let's say, for cash position. So that's why, this swing position was opened here. Jeff, what do you see here? How would you trade it? And what kind of advice would you give me here on this couple of trades?
Okay. Well, first and foremost, I totally agree in the direction. I'm very much of a trend trader. So when I see a market like this, I get excited because the way I trade, it's not necessarily get in at the very beginning, like back in March or
Right.
April, and just hang on for your dear life and hope the trade works out. I like to be a little bit more involved in my trading. It's kind of like my trades are my children. I want to be very involved in their lives. I want to know what's going on. Okay, so I see several opportunities here along the way, but all of them, again, are going to be very much to the upside. Like, for example, right over here, okay, this whole movement to the downside, you have a nice little opportunity to buy the market. So here's a small little opportunity trade that could have been 5 days, that could have been a little bit longer. This is a trade setup that I very much like because I'm not sure if the attendees are aware of this, but I use this rule of thumb, and it is very much of a rule of thumb in my own trading. Highs and lows for the month tend to occur during the first few trading days of each new month. I don't care if you're trading E-mini S&P, Apple, British pound, crude oil, doesn't matter. Whatever market you're looking at, go back and take a look at, say, the last 2 or 3 years of trading and count the number of times the high or low for the month actually occurred during the first few trading days. And you'll see the consistency is amazing. Here's a small little corrective decline. So that's a nice little buy side trade. This chart pattern from an Elliott, not from an Elliott wave perspective, but from a candlestick perspective, this would be actually referred to as a tower. That's actually another bullish pattern here. This movement right here, clearly counter trend. So this allows me to, play the buy side with very well-defined risk. And then as we move over here, probably would have missed, gotten in a little bit later here. I probably would have traded for my trade setup again during the first few trading days of each new month. So my style of trading is, and I primarily do options on individual stocks, would be to say, for example, buy some like $30 call options with maybe like 3, 4, 5 weeks out. Boom, make my money, I'm out. Boom, make my money, I'm out. I tend to be very short-term oriented, 3 to 5 days, or even say maybe 3 to 5 weeks. But as you can see, if you understand, if you can read a price chart, we're talking like technical analysis 101, just simply being able to read the price chart, understand that, again, whether you're looking at Wyckoff or Elliott, these two forms of analysis really focus on crowd psychology. And it's important to understand that this crowd psychology does indeed form patterns on price charts that repeat. Buying opportunity here and here and here and here and here and here. So there were several, and even recently, this little pullback right there, that's a 3-wave move. That gives me a nice buying opportunity. That's the second trading day of the month. So on the third trading day of the month, I'm basically long with a stop on day 2. And again, wonderful opportunity. I love finding these trending markets that trend month after month after month, because it's like an ATM. All I do is jump in, hold my position for a week, 10 days, because on options trading, because of the leverage, and depending on the shortness of the, whether you're buying in the money, out of the money, way out of the money, short term like weekly options, you can make 20, 30, 40, 50, 60% return on options, very easily, I think.
Oh yeah, for sure, for sure.
In fact, Roman, I've seen you do a 10 times trade a couple of times.
Yeah, that happened a couple of times. Yeah, for sure. Yeah, and in the crypto world, obviously, this is just like crazy sometimes. I've never experienced anything like times 100 or something like this, but I've seen those type of trades. All right, well, let's jump to the next trade. So this is a swing trade. This is from 2018, and I still keep those. I think it's very valuable to keep your trades, to put them, on a slide like this for yourself, and go through the post analysis, and then, obviously I use them, for my studies with students as well. but keeping the track of your trades and going through them, reminding yourself of the mistakes that you've made. So these are purely swing trades where you want to take some portion of the move. So you want to be precise here, identifying, where there is a confirmation of the continuation that comes, and also where this potential stopping action might happen. So with this trade in NVIDIA, we're seeing how a very much leadership stock has been stopped. We're seeing that value sellers are selling into the highs of the rally. That stops the price from moving further up, creates the change of behavior that is suggestive of the trading range. The trading range, because of the momentum characteristics of the uptrend, is upsloping with the higher highs, higher lows, suggesting that we're going to see a lot of elements of the reaccumulation in this structure. And we do. Look at this rally right here. Look at this diminishing supply character into the lower volatility, almost apex formation. That suggests what? Suggests the rally. The rally comes and creates an upthrust, and it's this break right here that tells us that something else is happening at this point. A change of behavior is going on. And obviously, October 2018, already the market under pressure. So that gives you a little bit more confidence to establish a short position. Now, I must say that this is not my best trade, by far. My intention was to take more here. And I think that maybe, Jeff, you could help me out here if I would be thinking more as an Elliottician. I'm going to butcher this count, but I'm thinking like, there is, this portion of the wave, and then this portion of the wave. Am I correct or wrong?
Yes, yes and no.
Yes and no. Okay, hold on a second. Let me.
Okay.
So this is a little bit more significant to me because the reaction up here is somewhat more than this. So maybe we have kind of like these two big portions. Probably totally off.
Oh, no, that would work. Absolutely, because I think that gives you a nice balanced structure to the downside.
Okay. Well, I guess my question here for this trade is, let's say that you get in at the same spot. And let's say that your intention is actually not to get out here, which I thought that, for that particular point, if you want to get out here, that's actually okay. Volume signature is increasing, suggesting temporary emergence of the demand. But what if your intention was to take more? How would you use Elliott wave to assist you in staying longer in this position?
Okay, well, the way I would have traded this, or just again my approach, I love the setup, and I'm totally agree, because if you look at the chart right here, this area, that's a small little three-wave move up, where prior to this event that you see here, your declines were still unfolding in three waves. But over here, now your advances are developing in three waves. So you're beginning to see a change in personality, as you described in your slides on accumulation and distribution. Also, too, and this is something that we sometimes lose sight of, notice during this entire phase of the market, those many, many months, the market was attempting to rally, but it was sluggish. It was, I like to say in my work, when a market rallies, it means something. When a market fails to rally, it means something. So we spend all this time in NVIDIA, and we're trying to make new highs. We do make new highs, but it's not easy. It's very much of a struggle. Then we take out the prior swing low here, we take out the prior swing low here, and now we start to see our advances. This is a beautiful trade. I probably would have done the same thing, and I probably would have gotten out. I would have exited, and I would have patted myself on the back. And then what I would have probably have done is simply look for a re-entry during this small counter trend move right there, because I have no doubt that if I were to look at a 60-minute price chart, this movement would have been a small three-wave counter trend move. So the way I would have traded this would have been, I would have done exactly like what you did, Roman. Sold here, exit here, sold there,
Mhm.
definitely exited down here, probably sold again because you have an evening star formation right there.
Mhm.
So sell, take my profits, sell, take my profits, sell, take my profits. Or what you could have done, okay, I'm short, say 15 puts, and the puts I'm short maybe 200. Those are my 200 strikes, okay? At this level, I let 5 go, okay? And
Mhm.
then as the market continues to move down, I let another 5 go at 160. And then maybe I let another 5 go at 130. So there's, again, one thing that I think is very, very, very important for people and traders to understand. And I talk about these lessons all the time in Traders Classroom, one of the services I write for Elliott Wave International. There's not a single best way to enter a trade. There's not a single best way to exit a trade. There's not a single best way to manage a trade. Those are decisions that you're ultimately going to figure out for yourself. And when I look at this trade, hey, if I made money, I did my job. I made the cash register ring. I'm perfect. I have no problem with that. But there are several different ways you could have approached this market
Mhm.
to capitalize on the extent of the decline.
Yeah, I would agree with you. And I think this is a very, very useful thinking and approach as to, yeah, you made the money here. So what's going on next? Okay, you have a reaction up where from the point where demand has emerged. Demand is starting to go down. Do we overcome the last capitulation bar or one of the last capitulation bars? No, we are in the upthrust position right here. And then again, we're going down with ease on smaller effort to the downside. So yeah, it does make sense to rethink the re-entry here. So yeah, Jeff, thank you so much. And that would be really good. This trade would be much better than the previous trade just because of the bad gap down and how the premium increases as volatility increases. Okay, well, let's go to the next trade. It's from the same period from 2018, and this is in Russell, just because Russell has been much, much weaker in the redistributional formation after a failed spring. And there are different variations on the spring, like there are different variations on the wave count in terms of the structure, or rather, no, different structures in the wave in the wave principle. This spring here, we would say that this is a spring type. It goes under the support, but look at the close of the actual spring bar. It's not very convincing to the upside. We are not seeing, let's say, a spring like this, where we go under the support and we recover really quickly into the body of the significant bar to the downside. This spring right here does the same thing, recovers into the body of the capitulation bar. This spring right here recovers with 2 or 3 bars into the capitulation bar. So that's very important. It just shows you that the buying is sufficient and strong enough to push the price into the levels where they were selling before. This doesn't do it. So from that perspective, the failure was really easy point of entry right here. And then I'm exiting a little bit earlier. My preference would be just to wait for more of the climactic action right here. Probably this would be a little bit better exit. But Jeff, I think in terms of just hit and run type of swing trade, I think that was actually not bad.
Oh no, you did a phenomenal job. And I think you'll laugh at my at my response on this.
Okay.
I and the reason why is I think I probably would have missed this entire decline because over here I'm still thinking that the larger trend is up and that this consolidation is going to give way to further rally,
I'm
and
sure.
it didn't.
I'm sorry. Are you showing us something? I don't see anything on the screen.
Oh, I'm sorry. Okay, here's my
Yes.
cursor.
Uh-huh.
This period right here. That's clearly a sideways consolidation. I would have been looking for this market to continue much higher. So I actually would have been looking to buy the market right here. And then we have the breakdown. Okay. If I was on my toes, maybe I could have gotten a trade off in here. But let's say, hey, I'm kind of like shell shocked because I'm looking up and the market's going down. So I stand aside. Then the market comes all the way down here. So at this point, I'm looking for an A, B, C up here. So here's my sweet spot. That's where I want to actually sell. But notice the market didn't get there.
Right.
See, I want I don't want to chase the market. I want the market to kind of come to me. So this is a good short trade for me, the way I look at the market at this point. But as you can see, the market never got there. So I would have probably totally missed the entirety of this decline because I'm waiting for something to happen, something I recognize my setup to develop, and it never did. And the market just got away from me. And that's going to happen.
Sure. Yeah. And the reason why it never came to this point is just because Russell, at that moment, against the S&P and NASDAQ and the Dow was the weakest. So it couldn't produce this rally. And the other rallies actually never had, if I remember correctly, the structure, they never had the upthrust as well. And in a way, I'm missing that too, Jeff, right? Because I'm entering later on. I'm entering kind of like at this, confirmatory spot. After we already committed below the support, we're trying to rally, we're failing there, and then a confirmation comes. So, it was a relatively good small short trade. Okay, let's jump to something else. Oh, let's switch gears. So this is futures, S&P E-minis. So this was actually not a bad trade, not necessarily a perfect trade. And we could say that we're not looking for the perfection. I'm kind of in my mind still dealing with this. I am looking for the perfection, just to improve, how I trade in general. I think after the shake, when we start the session, the recovery back basically gives us an idea that there is some kind of reversal is going on. And that is happening a little bit on the abnormal volume signature. So usually when you on the E-minis have that type of abnormal signature, not at the beginning of the session, but somewhere later on, that signifies something significant, some kind of potential for the reversal. We reverse, test, and we hold it. And that's enough for us to start considering that we might be in some kind of trading range formation, which is a little bit obscure, but it had a point of fear where some weak hands capitulated, and then there was some buying on the way down, and we recover and we show a change of behavior. With that, we want to get in at the beginning of the confirmation. So if the rally and the reactions show that change of behavior, we want to come in on the reversal of that pattern. And then basically hold. Hold where? Well, target number one is going to be the previous highs. So here we are coming into this target. So what was the decision there not to sell? Why? Even though supply is emerging, we're seeing this from the volume spike, right? So any volume spike is going to have our equation where we're going to say demand is increasing because this is a demand dominant environment with the up spread increasing, demand is there, and so on and so forth. But because of the volume spike, supply is increasing as well. And we are expecting here a stop in action, reversal, change of behavior, maybe a trading range, and all of those things did happen. But why not to sell here? So in the moment, the thinking was there is too much momentum behind this move. It doesn't look climactic. It only looks intermediate type of climactic stop in action. But there is so much momentum after a grind up, we're going to have another leg up. So on the next leg up, these red lines are our target zone. This is where we want to give up. And this target zone comes from the long-term resistance. So this is when we want to close the position. I don't think that this is a perfect exit. And I know that Jeffrey is going to, kind of like blame me for this perfection, but please entertain me. The reason why I'm saying that this is not a perfect exit is because even though we see how momentum on these mini swings is starting to diminish, we don't yet see a more confirmatory signs of the expansion of the result to the downside, which would be more evident in a bar like this or this. And I think, to me, just from the kind of like the purity of this trade, or the purity of the methodology, this would be much better exits. But having said this, am I happy I made money here? Absolutely. Jeff, it's all yours.
Okay, well, I think this is a perfect trade, and I think it was a perfect exit. Okay, um, because unless you sell top tick, you're never going to be happy with your exit. Okay, so there's a big difference between progress and perfection. This is why I don't look for necessarily perfection in my trading. I'm not looking to be perfect and buy the bottom tick and then be perfect and get out. I'm looking to make progress. And my progress is to get in a little bit late, confirming price action, and get out when I've made a sufficient amount of money. I think this is perfect. You have a delayed entry and you have an early exit. In my opinion, that's a perfect trade, Roman. So don't don't be upset that you didn't get out at the very tippy top, because
No. That I definitely didn't want to get at the tippy top, but I want to get out at the logical kind of like science of where we know, like, that's it, it's done. So
okay, well,
yeah.
I think it's a perfect trade, and I totally agree. For example, beginning here, you've got your three-wave decline, your A, your B, your C, nice trend line break. So this basically tells me with the three-wave decline that the larger movement's going to be to the upside. I actually would have been even later on the entry. I would have been entering here, okay? Because notice up from the low, you have an advance, a decline, and then another consolidation point. So what is occurring is you actually have a shelf of resistance building in the market. Then you move through the resistance, and then now that what was once resistance is now becoming support. Okay, so that essentially confirms the trend change. Also, too, this price action is all counter trend. So I would have entered the trade here, probably gotten out on the spike, because that's a nice volatile move. As you can see, though, from here to here, that's another three-wave move. So I probably would have gotten in again to the buy side. So I would probably say this, for me, this would have been two trades. In right here, out here, and then in right here, and then probably out where you got out, if not maybe a few days earlier. So this would have been a two for me. But I think I see no issue with your approach. Again, late entry, I like that, because you wait for confirming price action. You don't get sucked into that ego game of trying to pick the bottom, and then you get out when the getting's good. You're in resistance, as you said, right here, this whole area. This is a nice area to be looking to exit. Why not leave the party early before the cops show up? And that's exactly what you did. This is a perfect trade, in my opinion.
Yeah. All right. Okay. Well, that's great, Jeff. Thank you so much. Okay, let's go to the next one. This is a swing trade in Netflix, 2019. So it was a very interesting story about, I was reading institutional research, and it was interesting how Netflix was underperforming the market, and was, I believe, underperforming the tech group in general. So whenever there is a relative underperformance in the stock, and especially you could see this from this type of action, like, it doesn't go anywhere, and relative performance is just down. So you could see, like, from the relative strength, we're in the downtrend. Not going to be favored by institutions by any means. And it was very interesting to observe how every time we go down on some kind of gap in action, or maybe just a very sharp decline, we're seeing some supply coming in. But every time the duration, or rather the depth of this sharp movements down, they diminish, and then the final one creates a higher low. So that is a bullish pattern for us. And then we're also thinking in terms of the larger structure. So we're thinking maybe phase C here somewhere relative to phase A, phase B. So we should be in phase D where a sign of strength should happen. And here we are taking the trade right at the point of the breakout. So again, as Jeff's saying, we're not at the bottom. We're not buying at the bottom. I think that there was an opportunity to buy somewhere here, and we're buying relatively, early into the trend. So what happens? Here's a continuation of this trade. So here's our point of entry. I'm exiting early to my liking because my target was obviously, to this level and slightly above to 400. And I think that I'm just kind of like seeing into earnings, and this is a very common thing to see before earnings, some kind of increase of volume, increase of selling and buying at the same time. And I don't want to be sucked into some kind of negative earnings, and I'm closing here. So that was the trade. Obviously, the intention was a little bit, to hold it a little bit higher. So mistake number one, exiting. This is kind of like a most visible mistake. Mistake number two here is after this bar and after this reaction, not re-entering and not taking the rest of the move. So that would be probably a more logical way of behaving, with this trade. Jeff, what are your thoughts?
Well, I think you're being too hard on yourself
I always am. I'm Russian. So what do you think?
on your initial entry point, on your initial exit point. Okay, right here. But let me see. I guess where I would have entered the trade would have been probably right here, because you have a nice down, up, down sequence. So uptrending market. We have a series of higher highs and higher lows. So I know the larger trend is up. I've got the wind at my back. Three-wave decline, uptrending market. This is kind of like a no-brainer trade. Getting in right about here, probably getting out there because that is a bearish engulfing pattern. So I'm in the market 5 days, I make 50% on my option. Okay, now with your entry point, you were much earlier than I was. But I think it extremely prudent to have gotten out before earnings, because earnings, and I teach this in my work, earnings are a crapshoot. Earnings, or it's a 50-50 chance whether you're going to be right or wrong. And you've seen this as well as I do, where you're trading like XYZ stock, you're expecting the market to beat the numbers, and the market beats the numbers, and what happens to the share price of the stock? It falls through the floor. Or say you're trading ABC company and you know they're going to miss earnings, so you buy a whole bunch of puts. What happens? They miss earnings as expected, but not as bad as everybody thought. So what happens? The stock rallies. It's almost like it's a no-win situation. So I totally, again, go back to my whole idea: manage risk. Always, always manage risk, because if all of a sudden after earnings the market's trading down here at 300 or 290, you look like a brilliant hero because you avoided. But what you could have done, like what you said, is simply get back into the buy side following that period of congestion. So I think it was you were demonstrating the ability to be, say, risk averse in front of earnings, and I think that was very smart. And then just, here was the second opportunity to get in, and that was it. But still, this was a profitable trade. You managed risk. You did your job. You made the cash register ring. Period. End of story.
All right, Jeff, this is so insightful. To kind of like hear your take on this trade. Okay, so what do you think about this one? So this was a show-off trade, and it was also a revenge trade. So I'm gonna be a total student right now. The reason why it was a revenge trade is because I've entered a long trade right here, and then again I exited earlier And then once the price started going up after this big gap, after this big spread, I kind of, was withdrawn from this trade. And as it was starting to go up again, like I had such a the definitive kind of like regret of identifying the bias correctly, identifying the timing correctly. And, in a trade like this, you want to be in a trade like this on the way to the upside. So I was so, I was so emotionally unbalanced about my exit here, premature exit, that I said that I'm going to catch the top. So here's the climactic run. How do you catch the top? Well, you want to find the last exhaustive moves to the upside that look extremely bullish, where the price almost like doubles and where there is a lot of volume, there are a lot of exchange of shares. And when you want to catch this top on the intraday level, and your idea here is that from the top, because this was speculation on the way up, and in Wyckoff we're discussing this as a hypodermic action, kind of like this TP, Indian TP formation, speculation on the way up and then urgent selling on the way down. I wanted to catch that urgent selling on the way down just because I lost, this trade. So you need to identify the conditions of the climactic run. That's number one. Secondly, you need to go to the intraday and find a point of entry on the intraday. So I thought that on this particular day, I've identified an intraday climax action. Change of behavior was still showing some strength, high or low, but I already kind of knew by the volume signature, by where the price was, how it gapped overnight and during the opening, hours, that we're done. So I just wanted to have some kind of test, secondary test, and then on the reversal just to come in. So I bought puts here. Actually tweeted this, as sometimes I crazily do tweet, those type of calls or trades, and said, okay, sweat it out with me. The price was going up, but it doesn't really influences me because I'm in options. It's a very highly speculative position, so I'm not necessarily sweating. I know my risk with options, but the close was very favorable. So it was an almost $100 bar down on a lot of volume signature, lots of selling, and price follows that selling, and it follows it now more than the change of behavior, and this reaction becomes even more. So I kind of already feel really good about this trade into the close. Not only it's profitable, but it shows me that there is more potential to the downside. And here's how it's unfolding overnight. This is the overnight action here, and then into the next day. And these were very short-term, trades. So originated right here, and then at the open, I'm closing partially, and then I'm just closing off my position and scaling out and leaving just 1/4 of the position to hold on if we're going to have even lower prices. So my point of entry was around 900. My lowest exit on this chart is about 700, and that happens just overnight, like in one day. So I think that was a good trade. And Jeff, again, I'm going to talk like a student right now. I felt revengeful. I went for the top. I got it.
Okay. Well, if there's one trade that you've done that I don't like, it would probably be this one, because the impetus of it was top picking. I'm not a fan of top
Yes,
picking.
absolutely.
And it was at its origin emotionally driven. Okay, so I try and keep my emotions out of my trading. And so this would be the really the one trade that is almost like counterintuitive to the way I look at the market.
I
Now,
would
having said
definitely,
that,
I would
now,
definitely not advise this to you guys. Like it's something else. It was really more like maybe just kind of like wanted to prove it to myself that, you know, I missed that first trade. This one I didn't want to miss. I didn't want to miss
Well,
at all. Yeah.
well, Roman, I'll be honest with you. I mean, there are times when, like for example, my approach, I trade in the direction of the trend. I've got about a dozen different trade setup, quote unquote, trade setup patterns that I look for on charts. Whenever they happen, that's when I pull the trigger. But there are times, admittedly, when I myself will attempt to say pick a top or pick a bottom. So I will actually do what you did here. But I also acknowledge whenever I'm doing it, it's like, okay, hey, this is totally a speculative trade. This is exactly how I shouldn't be trading, but I'm feeling lucky today. What the hell? I'm going to go ahead and do it anyway. But you said something very important whenever you were describing your thought process through the whole thing was you knew what your risk was. Okay, you knew what your risk was because you were trading options. So in other words, if everything blew up, you knew how much you were going to lose, 5 grand, 10 grand, and you were okay with that. And that's simply, the reality of the market. It's simply being an adult. And that's why I love trading options so much. Every time I put a trade on, I know, hey, if everything goes totally wrong and I lose everything, I know exactly how much I have at risk. And that really does allow me to manage my trading, in my opinion, much more effectively. But if you cannot be an angry trader, that's what I really would recommend.
uh, Actually, now I remember. So this was when? Yeah, this was right before COVID. I just remember that during COVID, when we had, let's say, volatility went from $16 to like 82 or something like this. So it was a very interesting challenge, Jeff, to catch the top. Not from the perspective of even the trade itself, but more of like a proof of the method, a proof of the skill, and to kind of like show this to people as well that you could do that, that it's possible. So I remember I caught the top in volatility at 82. That was fun. I caught the top in TLT. That was fun as well. And there were some other kind of like top and peak trades because I think environmentally it was an easy time to pick up the bottoms. Like I picked up the bottom, of COVID decline as well, just because of the extreme
Mm-hmm,
behavior,
mm-hmm.
and they were just like so visible and like they were available, and there were abundance of them because of what was going on.
Yes,
So
yes.
yeah, I think
Well,
partially
brilliant
that's
job.
also what that was. Yeah. Okay, let's go to the next one. Okay, so this one is E-mini futures. Also, a really good trade. For those of you who are interested in Wyckoff, I just want to point your attention to this formation right here. So what do we see here? The background. The background is most definitely to the upside. So we are trading to the upside. And then we see that we are, after the rally, we're coming in into the change of behavior that suggests a trading range. So we let it go and we just observe for how the trading range unfolds. You could have smaller trades here. You could have a trade here to the upside. But we want to catch like, one or two or three big moves during the day on this time frame. So as we are observing the trading range unfolding, higher highs, higher lows, with the upthrust action, all bullish, and volatility together with volume goes down. So we're seeing how volatility on this decline is almost not there. Last bar for the amateur might produce some kind of hesitation, but as we're studying Wyckoff methodology, we know that increasing effort to push the price down with the limited result of it usually suggests presence of the demand. And we only need to seek some kind of confirmation, which comes really fast. And this is our point of entry. And as we go through different reaccumulation ranges, we observe the character of those. what is the character here? Flatness. There is no too much aggression on the reactions. A couple of sprints, tests that all materialize into the continuation to the upside. So there is nothing to be afraid, nothing to be scared of in terms of potential exit. The supply that is coming in sometimes, let's say around this area right here, does not produce a big result, does not change the character of the price. Again, confirmation that we need to continue with this trade. And then our first exit is here. This is just based on this swing right here. What we're seeing is that momentum character from this swing to this swing, well, first to this one and then to this one. Look at the spread, how it starts to diminish, right? So if momentum was increasing here, momentum still increasing, but slower, and definitely momentum starting to decrease. So we're seeing how demand starts to deteriorate. We want to exit on the first signs of the change of behavior, which will be a change of behavior bar. So a change of behavior bar comes, I close this position, the position goes up a little bit higher and then goes into a trading range, and that's it. That's all she wrote. So, Jeffrey, this is probably a perfect trade for me. Like I would say that, I feel fully satisfied with this trade.
Well, good. You got to feel good about what you do. No,
I'm sorry. I'm sorry for being so critical of myself.
Well, I think you do phenomenal work. I just think sometimes you do great. You do a phenomenal job. I think you're just a little bit hard on yourself. I think the entry's fine over here. I haven't traded an E-mini NASDAQ 1 minute chart in 20 years. I used to day trade, and I spent about 1.5 years staring at tick charts and 1 minute charts and 5 minute charts. Drove me insane. But this is a brilliant trade. I probably would have looked at this. Number one, I wouldn't be trading a 1 minute chart, but the trade setups I see would have been, and this is my old trading style, I would have gotten in here with a 10 tick profit target. As soon as it was hit, I'd be out. I would get in here with a 10 tick profit target and then be out. 2 trades, I'm done for the day.
Yeah.
But that would have been with 10 contracts per trade. So
yeah, it makes a lot of sense. And I like your entries. Why? Because they are all in line with the bias that we have in the uptrend. So we just
yes. Oh yeah.
Yeah, we're
always
looking for
trade in
those,
the direction of the uptrend.
Yeah, we're just looking for those areas of accumulation. And you can use, guys, the character of the reaccumulations to assess, are we going to have a continuation or not? So you need to have something more significant as a change of behavior before we go into much more prolonged trading range, where you're going to oscillate your trades between the resistance and the support. Okay, well, we are at 4:40. Let's go and see what else we could do. Here's a very interesting trade. I want to show not only good trades, as you guys, for those of you who are in our community, you guys know that I show a lot of my trades. I mean, like, I don't have mercy on myself, as Jeff, now could see. I want to dissect them completely. So we have a process that we call anatomy of the trade, where we do the post-trade analysis. There are specific characteristics that we look for the trade. To be a successful trade, we do the variance for each trade and so on and so forth. This is a losing trade. So majority of the trades that I actually discuss in the anatomy of the trade, I'm actually kind of surprised that, I'm not hard on myself and I'm not putting more of my losses, kind of showing some wins. So this is a losing trade that was supposed to be a winning trade. And it would have been a winning trade would I not have exited this trade. This was actually a hedge fund trade, which makes it even worse. In phase, the renewable space, which I loved so much, on this last leg up that they had, and obviously a leader in that space. We have a very weird formation here where a deep reaction with a lot of gaps, so lots of selling is going on, and then recovery. It's in the recovery that we could conclude that we are in some kind of accumulation pattern. Reaction confirms that. As the price goes down before this big bar to the downside, we're seeing how the spread is diminishing. We're seeing the shortening of the thrust to the downside. We're seeing how supply is diminishing. We know that there's going to be a move to the upside after this. The matter is of just identifying a reversal, which I thought that we had right here. I reversing the last commitment to the downside. Next day, I'm feeling good. And then the day afterwards, there is a 30% decline, which you could see on the intraday level right here as well. So what happens during this decline? A purely institutional story where one of the hedge fund managers, whose job is basically to go and identify some kind of potential accounting, miscalculations, fraud, and taking short positions in those stocks and announcing after those findings were found to the whole world that the accounting is wrong, having this short position, which I think is totally unethical. And then as this hedge fund manager announced that there was accounting fraud, the market, the stock drops 30%, and I'm caught up in this 30% move. As a hedge fund, I don't have stop losses. This is not how the hedge fund would necessarily operate. You would have like more of the stop loss where it is a catastrophic stop loss. So basically at this point you manage a position because your risk in hedge fund is so small. Like for instance, personal account, I could easily risk 5% and I wouldn't even blink. At the same time, in a hedge fund, you risk 50 basis points, so 0.5%, and you start coming into the position in chunks, 10, 10, 10, 10, 10 basis points. So this is a completely different risk profile for this trade. So as you're managing the trade, what's the idea here? Again, you can use your methodology to understand, how to manage a position. For instance, here we're seeing this washout, a shakeout. The volume signature has increased a lot dramatically. It's one of the highest volume signatures on the chart for a long time. So you know that behind this there is some demand. You want to wait for some kind of at least partial recovery out of the oversold condition, which I do in the morning of the next day. And I kind of feel like I want to get out because I don't want to go into the retest. So I think the mistake here was not thinking about the trade management per se. I think as I post-analyze this later on, the mistake was exiting a full position. Would I have exited, let's say, 1/2 and would give it a chance to prove itself and go into much better testing action? I think I would be better off because here this presents an opportunity to add to the position. And then this event here would be perceived as kind of like a black swan event that has happened just because of that, hedge fund story. And then by adding to the position and then being in the uptrend, which went to, I think, above $200, within like 3 or 4 or 6 months, that would have been, probably one of the best trades, for that period. So, Jeff, I'm kind of bummed about this.
Okay. Well, two things. We have to get together and have a beer.
I know.
You're the way you look at your work. I think again you're being overly critical. I see nothing wrong with this trade. Okay. I would have done exactly what you did as far as buying. This is a nice little 1-2-1-2. That's a wave 3 top. You come back in wave 4. You're right into this, buy zone right here. You did everything right. Okay. Well, what about the big move down here? Okay. This is just life. This happens. Not all your trades are going to be perfect. So rather than looking at rather than looking at a trade simply being, did I make money or did I lose money? you rather than focus entirely on the destination, you have to really examine the journey. Did you trade right? Did you trade well? Was everything set up the way it normally is and it typically is for you to take the trade? And in my opinion, it absolutely was. This is one of those Jeffrey's Law things. Whatever adversely affects the most people tends to be what happens. This is simply life. It happens, and it's going to happen. That's why as traders, we manage risk. I think you were very smart getting out the following day because, again, you simply, I don't know what's going on because this issue could have easily just continued to go lower.
Yeah.
You did not know.
Yeah.
So what did you do? You eliminated the risk. And I don't think that really you got an all clear as far as further upside until you really got back above the 5250 handle, which would have been really at this point much later in the month or the following month. But going back to your whole logic, what brought you to the dance, and so to speak, you did nothing wrong. And subsequently, when it went south on you, what did you do? You immediately eliminated the risk on the position, which is your job. So I don't see how this, even though you lost money here, how, if I was your boss, it would be like, okay, hey, not a problem. You did your job. That's what I hired you to do. You took a very viable trade setup over here. It didn't go your way. You certainly weren't hanging out for the next 2 to 3 weeks, hoping it would go higher. That I would have had a problem with, because anytime hope becomes part of the trading equation, it's a mistake. This is life. It's going to happen. That's why we carry spare tires in our cars. At some point, you're going to get a flat tire. So you just change the damn thing. You did I see no issue here.
I see no issues too. I'm just thinking, was there anything, and post-analysis, by the way, kind of like examines that the variance was very high for this trade. I mean, like the setup, the point of entries, the stop loss, the trade management after, everything was great. It's one of those trades where the variance is extremely high, so meaning that you're doing everything by the plan, and yet the result is a loss. And as Jeff has said, it happens. And so ironically, it was very interesting. I've encountered this guy twice now. It's his business to do this type of things. And on the second trade, I didn't do anything. So that was actually a good learning experience. Okay, I think we have time maybe for one more trade. Let's do that, and then we're gonna stop. Let me kind of like see. Yes, this is beautiful because again, I want to show, and again, this is the trade where, like the previous trade, everything was done by the rules. There is nothing wrong in identifying the setup, going for that, and then it just doesn't materialize the way how we want it. So look at this stock, BioMarin Pharmaceutical. This is a long-term accumulation. We're here in the trading range for 4 years, 3 years, 4 years. We are seeing how there is a lot of testing in the middle of the trading range before the price finally goes to the support. So we're identifying this as a spring, temporary commitment down, a recovery back, and we're thinking this is phase C. So at the time after the COVID low, which shows strength, the COVID low is the high low, which was very rare during COVID decline. Doesn't show extreme selling as well, just a local increase of the supply. So that shows a lot of strength. We come to the resistance, we are ready to break out, and usually my preference is to buy breakouts either before the major resistance or after a sign of strength, after the backing up action, and this type of spot, the breakout here. So I'm buying the breakout here before the resistance. What happens next? I'm feeling really good at first. So here is my entry, somewhere here. A really good test of this breakout bar. So we're buying more. We're buying more on the attempts to overcome. And then I think here just analysis might be a little bit off just because of how demand is showing up in the spread. We're seeing that the rallies are not that great. Jeff was talking about how we want to see like small reactions on the way up in the uptrend, right? Something like this. Whereas in the downtrend, we want to see this type of smaller reactions up. But I'm thinking long term. I'm thinking, what is the cause here for this trade? Multi-year cause. We've just overcame and hit what? 132. So we are at this level right here. And this is a hedge fund trade. So this is a long-term orientation for this trade. I want to see a backing up action and then continuation. And what happens? Earnings come, and look what happens on earnings. Well, as Jeff says, life happens. So, and this is not just the position where I am partially exposed. I have already not just probes, but I have a full size position. This was the largest drawdown in the hedge fund portfolio performance last year, which we still ended up really well. We ended up with, about 46% for the year last year. But this was the largest loss. And it just happens. What are you going to do? You only do, your risk management modeling and application, and you just hope that you're going to have one or two or maybe three of those per year, and your maximum drawdown on those. And our work on modeling this type of events, which is basically a black swan event for the stock, was really good. That, if you're risking X amount per trade on a trade that goes wrong like this, you're going to lose on the average X amount as well. And then you say, okay, per year, I'm going to have maybe one or two or maybe three of those. So you project that into the future like this for your portfolio performance. And then, if it comes, it comes. If it doesn't, it doesn't. Jeff, what are your thoughts on this?
Well, I totally agree. I think it's important for traders, aspiring traders, professional traders, to just simply understand you're going to have situations like this. This is simply the cost of doing business as a trader. It happens. It shouldn't happen all the time, but it does happen. At some point, you're going to get caught upside down on something because you missed something, whether you didn't realize earnings were coming out, or who knew that the accountant at XYZ company was embezzling billions and millions of dollars. This just happens. This is part of life as a trader. And I think as such, you just simply need to, and you did a brilliant job of explaining it, go ahead and plan on, say, okay, if I take 10 trades a year, okay, 3 or 4 are going to be losers. I'm going to lose this much money. Go ahead and work that into your business plan. It's what smart people do. It's what professional money managers do. And you should know that because you are one, Roman. This is how professionals do it. Okay, so if you're an aspiring trader, a new trader, somebody who wants to get into the game, do what the professionals are doing. And the professionals, as Roman just explained, they go ahead and factor in to their P&L a certain amount of losing trades. This is what I call life. It happens. I don't care how good of an analyst you are, you can't avoid this. This decline here, hey, I would have thought that was a fourth wave. I would be 1, 2, 1, 2, 3, pull back 4. Who knows? I might have actually been looking at this stock, back then, and covered it in my trader's classroom and said, hey, this looks like a phenomenal buying opportunity. About the only thing I probably would have said different would have been, hey, earnings, be careful of earnings. But beyond that, this happens, and there's no way to avoid it. So One way I kind of do a stress test on my own trading, Roman, is if I've got, usually for me, 3 to 5 positions, that's more than enough for me. I start moving beyond 5 positions, I think I'm overextending myself. And then what I do is I simply total up the total cost of those 5 positions, and I simply ask a very important question. If every one of these trades goes south, how big of a hit am I looking at? And
Absolutely.
the answer to that question is my stress test. Can I afford to lose 10 grand? Sure, not a problem. Done it a dozen times. Can I afford to lose 20? Well, I don't want to be that cavalier with 20 or 40. So I never want to have that much money exposed to the market because I know something like this is going to happen. The other day I was doing some analysis on a stock, Carrera. Ticker symbol is CARA. I think it might actually be a 420 stock or in the marijuana sector. And the same thing happened. I'm not really sure exactly what happened. It may have been an earnings thing, but we fell from 26 to 14 in a day. There you go. That's it. Now, look at the chart. Right here, I'm thinking, okay, hey, 1, 2, clearly wave 3, acceleration gap in wave 3, clearly a 4th wave pullback. I'm loving this. And look what happened. It's the same story you just showed in BioMarine.
Exactly.
So, but I guess the point I want to stress is the professionals, the people who do this as a living, they plan for this kind of event. So when it does happen, they're not shell-shocked. They're not a deer in headlights, but more importantly, they're not devastated. They shrug it off like a true professional does, and they move on to the next opportunity.
Yeah, exactly. Nothing else to do but just to go on. All right. Well, Jeff, this was really entertaining and very extremely valuable just to exchange ideas like this. I always am trying to solicit an advice from my fellow colleagues and traders as to to the nature of my trading, so that they give me some pointers. And obviously, I'm definitely receiving a lot of interesting thoughts that I will think about and maybe put them into my trading journal. So thank you for this. And then the third session, send us your questions, guys. That's number one. Secondly, we definitely will want to go maybe through some markets, and we'll update you on our views. So Jeff, maybe the major indices, the major gold, silver, oil, Bitcoin, just to give our students some perspective.
Okay, that's easy to do.
Yeah.
I've always got an opinion.
Yeah, yeah, of course. And then we'll talk more about the kind of like the synergy between Wyckoff and Elliott. So today, hopefully, guys, you kind of could sense in both of us in our discussion, how we both would approach the same trade, because basically it's almost the same trade that we are looking for. We are looking for areas of confirmation off the bottom after testing, after the reversal, after the breakout, and we are trying to get out before the major wave down hits us, right? And the opposite for the downtrend. So from that perspective, I think the trade is the same. And then we obviously kind of like thinking in terms of the structure. Again, what strikes me most about what Jeff delivers to us in terms of the knowledge, at least personally to me, is the character of the wave. That by the character of the wave, how it unfolds, we could define whether we're still in the uptrend or not, whether this setup is appropriate or not. So I'm really liking this, Jeff.
Oh, likewise, Roman. Likewise, and again, thank you so much for inviting me to be a part of the event.
All right. Well, with this, guys, thank you so much for being here. 5 o'clock. We're gonna be having our last session in a week. And again, send us your questions. Jeff, thank you so much. And everybody, bye-bye.